all of this. I want to go to David Nicholas of Nicholas Wealth Management, the CEO there, what he makes of all of this. Right now, the markets, of course, stocks doing well, kicking off this week, David, but they could run into turbulence based on a couple of developments, whatever Jerome Powell says. I have tracked that anytime Jerome Powell speaks, markets tank. It's uncanny. So we'll see. And then, of course, the Friday employment report, which might sort of, buttress his argument to keep these rates going higher longer than we thought. Where are you on this?
Yeah, Neil, if we could just cut out the video conferences for the Fed conferences, I think that we'd all love that a lot better. But yeah, look, there's a lot to be technical. There's some technical bulls for the market right now. So I think the bulls are in favor. If you just look at the 200-day moving average on the S&P 500, I watched this closely last week. 3940 is like the line in the sand. February 3rd, the S&P traded above that. It has stayed above that for now over 30 days. I can give you 70 years of data that show anytime the S&P trades above the 200-day average and stays there for longer than 18 days, that's been the start of a new bull market. So we've got to keep that in mind. That the technicals are in favor of the bulls. The problem is what you just mentioned, is we're in an environment where the Feds are still, although slower, still raising rates. Look, 90% of the time that the Feds have raised rates, they haven't been able to slow that height cycle without a recession. So I think that there's two camps here, that either we're going to fall off a cliff economically at the end of this year, or like Ken Fisher, who said, hey, we're at the start of a brand new bull market. The truth is probably somewhere in the middle, but for the markets, the interest rates in the Fed are what is going to be front and center. That's really going to affect which way these markets go, Neil.
What about interest rates themselves? Of course, the 10-year for a majority of last week was over 4%. Now under that, but not by a whole bunch. And the expectation is whatever rate increases we are to see, they won't be that dramatic. I don't know if that's a bit too sanguine a view, but how do you see it?
Yeah, I tend to agree with that. I think the risk for the market is not how high rates go from here, but it's really what's the duration of rates. If you look at Raphael Bostic, the Fed president from Atlanta, he said he sees the terminal rate going above 5%. And this is key, Neil, staying there into 2024. And that is what the market is missing. And I think you're seeing a lot more Fed presidents say that. That is our base case as well. We see the terminal rates get above 5%. I think you get post-elections 2024 where before we see that rate coming down. And this is why we think from the fixed income standpoint, you want to stay on the shorter end of the curve. It's what we've been doing in our treasury funds, really to take advantage of what we think could be a longer rate environment. But you're right, the risk for rates going much higher, I think, is lower. It's the duration that's really the market is missing.
You know what's remarkable, David? A year ago at this time, we hadn't even started the rate hikes from 0%. It started on, of all times, St. Patrick's Day on the 17th. It was a quarter-point hike. We would have never envisioned that a year later we'd be staring at a 4.5%, 4.75% Fed funds rate, one that you obviously think and others agree could go to 5% or higher. Where does this end?
Yeah. And I'll tell you that is the thing that I think has shocked most investors. But there is a reset coming for the markets, Neil, and it's because of what you just described. And it's so important. Is prior to last year, there was only one place to go if you wanted to get a good return. That was equities. You wake up today, we've got all these alternatives. It's like if you could have told me the first ETF that we ever launched would be a boring bond fund, I would have said, Neil, you're crazy. But look, investors are excited about bonds. And so this is where I think it does provide an alternative to the market. And that's where investors are going, for steady and security returns on their investment. So I think markets are going to have to prove themselves. Why should I go to equities when I can get 5% on a treasury? And I think that's going to put a malaise over the market, at least for the next 12 to 24 months.
Yeah, and to your point, there are CD rates and money market rates, some banks that are touting these figures that, are not just the quarter, percent, third of a percent type of numbers that some of the big banks have offered. These are very attractive, 4 or 5%. That can ease a lot of angst. So we'll watch how that goes. David, it's always great having you. Thank you very much.
Thank you, Neil.